Welcome to the deep dive. Today, we're going to tackle something that's probably on a lot of your minds, or maybe it will be soon.
Hmm.
It's the increasingly tricky world of auto loans here in 2025.
Yeah,
This isn't just your standard car payment anymore. It feels like the whole landscape has, really shifted.
it really has.
Mm.
And that's our mission for this deep dive, right? We've got a stack of articles, some research, our notes,
Right.
and we want to pull out the really crucial bits for you. Help you understand not just like what's going on with car loans, but why it matters so much for your finances and crucially, what steps you can actually take.
Mm-hmm.
Because honestly, for too many folks, what used to be a pretty simple purchase, it's turning into a bit of a financial trap, a sinkhole almost.
That's a good way to put it, a sinkhole. And yeah, our goal here is just to cut through all the noise, all the info overload,
Exactly.
and just give you those key takeaways, help you get informed without, feeling buried by it all.
Let's do it.
Okay, so let's dive in. The current situation. I mean, the numbers alone are pretty eye-opening.
Yeah.
We're seeing the average new car loan in 2025, it's climbed over $40,000.
40,000. Wow.
And the average interest rate, in a lot of states, it's actually pushing past 9%.
Oof.
And maybe what's more surprising, or, well, concerning, is that used cars, they're not really the budget saver they used to be either. Still quite pricey.
And what's really fascinating or maybe alarming is how these numbers all add up for you, the borrower.
Right.
People are borrowing more cash, okay, for way longer periods.
Mm-hmm.
And like you said, at much higher interest rates.
Mm-hmm.
Some experts are flat out calling this a, quote, recipe for debt disaster.
A recipe for disaster.
Yeah, I can see that.
And if you zoom out a bit, the data showing car loan delinquencies, people falling behind on payments, are at their highest point since, get this, 2008.
Since the financial crisis. Wow.
Exactly. So this isn't just, a car problem. It's wider than that. It's a credit problem.
Mm-hmm. And think about the ripple effects, right?
Yeah.
Having that much auto debt can actually make it tougher to get a mortgage.
Oh, interesting.
Or even just rented apartments sometimes, because lenders look at your debt-to-income ratio, and a big car loan throws that off.
So it's not just about maybe losing the car.
No.
Yeah.
It can actually hold you back from other big life stuff.
That's a really critical point. So, okay, how did we get here? What's driving all this? Why are car loans suddenly such a burden?
Well, there are a couple of main things going on. First off, just plain old inflation.
Right.
Car prices, they shot up during the pandemic, right?
Right.
And honestly, they haven't really come back down much.
Still feeling that sticker shock.
Totally. And then, layered on top of that, you've got the Federal Reserve hiking interest rates steadily, which just means it costs you more, sometimes a lot more, just to borrow money for that car in the first place. You're paid a premium on the borrowing itself.
Okay, so you've got expensive cars and expensive borrowing. But it's not just those big economic factors, is it? What about like at the dealership level? What's happening there?
Ah, yeah, that's a really important piece of the puzzle. Dealership practices.
Mm-hmm.
Look, a lot of people end up getting upsold on features they maybe don't need, extra warranties, and especially these extended loan terms they don't always fully grasp.
The long loans.
Exactly. It's kind of wild how common 72-month and even 84-month loans have become. That's 7 years.
7 years of payments on a car.
7 years. I heard this great analogy. It's like buying a cheeseburger today
Okay.
and still making payments on it a decade from now.
Wow. Okay, yeah, that definitely puts it into perspective. A cheeseburger.
It shows how kind of absurd it is to pay for so long on something that's losing value literally every month you own it.
Right, depreciation.
And just to connect back, when you stretch that loan out for 7 years, you end up paying way, way more in total interest compared to a shorter loan.
Mm-hmm.
You're essentially paying a huge premium for the same car.
Okay, so when you say these long loans are becoming frighteningly normal, who's most likely to fall into this kind of trap? Who's most vulnerable here?
Well, the research we looked at, it points pretty clearly to younger buyers being particularly susceptible.
Why is that?
A couple of reasons. Often, they might be coming in with what's called a subprime credit score.
Meaning their credit history isn't great.
Yeah, basically. It
Yeah.
signals higher risk to lenders, so they get hit with higher interest rates right off the bat.
Okay.
Plus, they might just lack the experience in negotiating these big purchases. It can be intimidating.
Sure, definitely. And is it just about age, or are there other groups?
Oh, absolutely. It's broader than just age. If we zoom out again,
Mm-hmm.
individuals in lower income brackets, they often get targeted with these offers that sound good up front, like no money down or buy here, pay here.
Well,
deals.
you see those advertised.
Yeah, but buy here, pay here often means the dealer is also the lender, and those deals can come packed with really high interest rates and pretty unfavorable terms. They can become financial traps very, very quickly.
Gotcha. Deceptive offers.
And then you also have folks like, say, military members or gig workers. Their income might not be as regular or predictable, right?
Right, variable income.
Exactly. And that makes keeping up with a fixed, potentially high car payment every single month a unique challenge. Puts them at higher risk, too.
Okay, so we've painted a pretty clear, if slightly worrying picture of the problem and who's most at risk.
Yeah.
So the really crucial question now is, how do you, listening right now, protect yourself? Let's shift to solutions. What can people actually do? Where do you even start?
Okay, step one, foundational. Before anything else, before you even think about visiting a dealer, your credit score.
Know the score. Why is that so critical?
Because a higher score directly means a lower interest rate.
Yeah.
Period. It's your leverage. Checking it before you go shopping is absolutely essential.
Okay, know the score first. Then what?
Then, building right on that, get pre-approved for a loan before you shop.
Pre-approved. How does that help?
Go to your credit union or check out online lenders. Get approved for a specific amount and interest rate. That does two things. It sets your budget firmly,
Right.
and it gives you massive negotiating power when you do walk into the dealership. You already have financing lined up.
Ah, okay. So you're not relying solely on their financing offers.
Exactly, which leads right into the next big point. Try really hard to avoid those super long loan terms.
The 72, 84-month ones?
Yeah. Aim for 60 months, so 5 years, or ideally even less if you can swing it.
Shorter term means higher payment, though, right?
It does, but you pay vastly less interest overall and own the car sooner. And, crucially, don't just roll expensive add-ons like gap insurance.
What's gap insurance again?
It covers the gap between what you still owe on the loan and what the car is actually worth if it gets totaled in an accident.
Okay.
Don't finance that through the dealership loan if you can avoid it. Those things can often be bought separately, sometimes cheaper, if you decide you even need them. Negotiate them separately.
Good tip.
Okay, what else?
Consider buying used. Seriously.
We touched on prices being high, but is used still better?
Generally, yes, because of depreciation. It's honestly kind of shocking how much value a new car loses the second you drive it away.
Like 10, 20% sometimes?
Easily. Sometimes more in that first year.
Yeah.
Buying a car that's already a year or two old, you completely sidestep that massive initial depreciation hit someone else already paid for.
Okay, that makes a lot of sense. Let someone else take that initial hit.
Exactly. And maybe the final piece of advice, and this applies to pretty much any big purchase. Try to separate the emotion from the finance. It's tough with cars, I get it.
Yeah, shiny object syndrome.
Totally. But remember, at its core, a car is transportation. It gets you from A to B.
Yeah.
It's not primarily a status symbol, even though it can feel like one.
Making logical, rational decisions based on your budget and needs, not just what looks cool or what the salesperson is pushing. That is absolutely key for your financial health long term.
Okay, so let's sort of wrap this up. What's the bottom line for you, our listener? This car loan situation in 2025, yeah, it's a real challenge. It's significant.
Yeah.
But, and this is the important part, if you go in armed with a plan, with the right knowledge, you absolutely can steer clear of these financial sinkholes we talked about.
Definitely.
It really boils down to knowing your numbers, your score, your budget, shopping smart, getting pre-approved, and just fundamentally avoiding borrowing more than you can realistically handle, especially right now. I mean, in this economy, every dollar really does count, doesn't it?
It absolutely does. And making informed choices on big things like cars is just more critical than ever.
So maybe a final thought to leave you with.
Given everything we've talked about today, the high prices, the rates, the long terms, maybe ask yourself, how might your approach need to change? Not just for cars, but for any major purchase moving forward. How can you better protect your financial well-being in what feels like a pretty unpredictable economy right now?
That's a great question to ponder. Well, we really hope this deep dive has given you some useful tools, some valuable insights.
Hope so.
Thank you so much for joining us today. We really encourage you to take this knowledge, apply it, and just keep making those informed decisions.